Question 1. Reinsurance principles, risk transfer and risk sharing. Which of the following best describes the fundamental purpose of risk transfer in reinsurance? A. To increase the risk exposure of the ceding insurer and provide no reduction in volatility. B. To provide the ceding insurer with an opportunity to transfer its financial risks to another insurer in exchange for a premium. C. To eliminate the risk exposure entirely for the ceding insurer, leaving no responsibility for any claims. D. To allow the ceding insurer to share all its risk equally with the reinsurer without any need for prepayment. Answer. B. To provide the ceding insurer with an opportunity to transfer its financial risks to another insurer in exchange for a premium. Explanation. Risk transfer in reinsurance is a fundamental mechanism where a ceding insurer, the insurer transferring the risk, seeks to reduce its financial exposure by transferring part of its risk to a reinsurer in exchange for a premium. This helps the ceding insurer maintain solvency and against large, unforeseen losses. While risk sharing is an integral aspect of reinsurance, it is essential to understand that the purpose of risk transfer is not to completely eliminate risk, but to mitigate it by spreading it across multiple parties. Question 2. Reinsurance treaties and contracts. Which of the following provisions would most likely be found in a surplus share reinsurance treaty? A. The reinsurer assumes a fixed percentage of every loss, regardless of the size or type of claim. B. The reinsurer only covers losses above a certain retention limit with no limits on the amount they will assume. C. The reinsurer assumes a share of the policyholder's premiums and losses based on the percentage stipulated in the treaty. D. The reinsurer will not pay out claims until the ceding insurer's retention has been exceeded by multiple premium. Answer. C. The reinsurer assumes a share of the policyholder's premiums and losses based on the percentage stipulated in the treaty. Explanation. In a surplus share reinsurance treaty, the reinsurer assumes a specific percentage of the ceding insurer's risk above a certain retention limit. This means both premiums and losses are shared between the insurer and the reinsurer in accordance with the agreed upon terms. The key feature is that the reinsurer's liability is proportional to the amount of the retention that exceeds a predetermined amount. This is different from excessive loss reinsurance, where the reinsurer only steps in once losses exceed a certain threshold and not proportionally across all claims. Question 3. Scenario-based question on claims management. Mr. James, a claims manager for a reinsurance company, recently received a large number of claims from a ceding insurer. According to the reinsurance treaty, all claims need to be reported within 30 days. Mr. James noticed that several claims were reported late, missing the deadline by a few days. The ceding insurer argues that the delay was due to administrative issues. Should Mr. James do in response to the situation? A. Deny all late claims and notify the ceding insurer of the breach of the reporting deadline. B. Accept the claims without question, as administrative delays are common and should be accommodated. C. Assess the claims individually, consider any mitigating factors, and communicate with the ceding insurer regarding the missed deadline. D. Inform the ceding insurer that the claims will be paid, but future late reports will result in immediate denial. Answer. C. Assess the claims individually, consider any mitigating factors, and communicate with the ceding insurer regarding the missed deadline. Explanation. Under reinsurance agreements, timely reporting of claims is crucial for proper management and settlement. However, a strict approach may not always be appropriate. In this case, Mr. James should assess each claim individually, taking into account any extenuating circumstances, such as administrative issues raised by the ceding insurer. Open communication and an understanding approach are key to maintaining a strong business relationship while also adhering to the terms of the reinsurance treaty. A blanket denial without evaluating the specific circumstances could lead to unnecessary conflicts. Therefore, it is important to follow up and address the issue with flexibility and fairness, ensuring that future claims are reported within the specified time frame. Question 4. Types of reinsurance. Excessive loss reinsurance. Which of the following best describes the nature of excessive loss reinsurance? A. The reinsurer participates in every claim, covering a fixed proportion of each loss. B. The reinsurer assumes responsibility for claims only when the ceding insurer's losses exceed predetermined threshold. C. The reinsurer covers all claims, regardless of size, for the full amount. D. The reinsurer's responsibility is to pay only the first portion of each claim, regardless of the total loss. Answer. B. The reinsurer assumes responsibility for claims only when the ceding insurer's losses exceed predetermined threshold. Explanation: excessive loss reinsurance is designed to protect the ceding insurer from large losses by providing coverage once losses exceed specific threshold known as the retention limit. The reinsurer is only responsible for claims that exceed this retention, and the reinsurer's liability is capped at predefined amount. Type of reinsurance is often used to protect against catastrophic events and large, unexpected claims. Question 5. Legal and regulatory framework, compliance and reporting requirements. Which of the following is a common reporting requirement for reinsurers under Wisconsin state regulations? A. Reinsurers must submit quarterly reports detailing their solvency ratios. B. Reinsurers are required to provide an annual financial statement to the state insurance department. C. Reinsurers must report only when their claims exceed a certain threshold. D. Reinsurers are not required to report to state regulators unless a claim is under dispute. Correct answer: B. Reinsurers are required to provide an annual financial statement to the state insurance department. Explanation: under Wisconsin state regulations, reinsurers are required to submit annual financial statements to the state insurance department to ensure solvency and financial stability. These statements provide insight into the reinsurer's financial health, including its assets, liabilities, and claims reserves. As regulators assess the reinsurer's ability to meet its obligations under the reinsurance agreements. Quarterly solvency reports may be required in some jurisdictions, but the primary requirement for annual reporting is consistent across many states. Question 6. Reinsurance principles, claims handling and settlement. Which of the following is true regarding claims handling in reinsurance? A. Reinsurers are responsible for direct communication with the policyholders of the ceding insurer. B. The ceding insurer retains responsibility for claims settlement, and the reinsurer only steps in to provide financial support once the claim is paid. C. Reinsurers must settle all claims directly with policyholders if the ceding insurer is unable to handle the claim. D. Claims are always settled directly by the reinsurer bypassing ceding insurer entirely. Answer: B. The ceding insurer retains responsibility for claims settlement, and the reinsurer only steps in to provide financial support once the claim is paid. Explanation: in reinsurance, the ceding insurer typically retains responsibility for handling and settling claims with policyholders. The reinsurer's role is to provide financial support once claim exceeds the retention limit or meets the conditions specified in the reinsurance contract. Ensures the ceding insurer can manage its obligations without bearing the full financial risk. While reinsurers can provide guidance or oversight, the settlement process is generally handled by the ceding insurer. Question 7. Financial aspects, capital requirements, and solvency considerations. Which of the following is a key consideration for reinsurers in ensuring solvency? A. Reinsurers should hold sufficient reserves to cover potential future claims based on their historical loss experience. B. Reinsurers should invest heavily in high-risk assets to increase potential returns, regardless of solvency concerns. C. Reinsurers are not required to maintain any reserves, as their solvency is guaranteed by the ceding insurer. D. Reinsurers are only required to maintain solvency if they operate in multiple state jurisdictions. Answer: A. Reinsurers should hold sufficient reserves to cover potential future claims based on their historical loss experience. Explanation: reinsurers are required to maintain adequate reserves to cover potential claims, which is the critical part of ensuring their solvency. These reserves are determined based on the reinsurer's historical loss experience, the nature of the risks they assume, and actuarial projections of future claims. Proper management is essential for reinsurers to remain financially stable and capable of meeting their obligations. High-risk investments and insufficient reserves can jeopardize solvency, leading to regulatory actions and potential insolvency. Question 8. Underwriting and pricing, risk assessment and selection. Which of the following is a key factor when assessing risks for reinsurance? A. The ceding insurer's claims history is not relevant as long as the premium is paid on time. B. Risk assessment should focus solely on the financial strength of the ceding insurer, disregarding the risks covered by the policy. C. Risk selection should consider the type and frequency of losses, as well as the geographical distribution of risk. D. Reinsurers do not need to assess individual risks if the ceding insurer is financially stable. Answer: C. Risk selection should consider the type and frequency of losses as well as the geographical distribution of risk. Explanation: Effective risk assessment and selection in reinsurance require a detailed analysis of the risks covered by the ceding insurer. This includes considering the types of risks, e.g., natural disasters, liability, the frequency and severity of past losses, and the geographical distribution of risk. Understanding these factors helps reinsurers determine appropriate pricing, coverage limits, and capacity. While the financial stability of the ceding insurer is important, risk selection is primarily based on the nature of the risks being assumed. Question 9. Types of reinsurance. Quota share reinsurance. Which of the following best describes the nature of quota share reinsurance? A. The reinsurer assumes a fixed percentage of both premiums and losses, regardless of the size or frequency of the claims. B. The reinsurer provides coverage only for large, catastrophic losses that exceed the ceding insurer's retention. C. The ceding insurer retains responsibility for all claims, while the reinsurer assumes liability for only specific risks. D. The reinsurer's liability is proportional to the amount of policy premiums paid, regardless of the retention. Answer A. The reinsurer assumes a fixed percentage of both premiums and losses, regardless of the size or frequency of the claims. Explanation. In a quota share reinsurance arrangement, the reinsurer assumes a fixed percentage of both premiums and losses. This means that for every policy written by the ceding insurer, the reinsurer will take on a corresponding percentage of the premium and any associated claims. This type of reinsurance helps evenly distribute both the premium income and risk exposure between the ceding insurer and the reinsurer. Unlike excessive loss reinsurance, where coverage kicks in only after losses exceed a certain threshold, quota share reinsurance involves proportional sharing from the outset. Question 10. Emerging trends and developments. Impact of technology on reinsurance. Which of the following is a significant way in which technology is influencing the reinsurance industry? A. Technology has made traditional reinsurance models obsolete, rendering the need for human underwriting redundant. B. Digital platforms and big data analytics allow reinsurers to better assess and price risks, improving underwriting accuracy. C. Technology has reduced the need for regulatory compliance, allowing reinsurers to operate with fewer reporting obligations. D. The reinsurance industry is not significantly impacted by technology, as the processes remain fundamentally the same. Answer B. Digital platforms and big data analytics allow reinsurers to better assess and price risks, improving underwriting accuracy. Explanation. Technology, particularly big data analytics and digital platforms, has revolutionized the reinsurance industry by providing reinsurers with powerful tools to assess risks and price them more accurately. Reinsurers can now use real-time data, predictive models, and advanced algorithms, evaluate potential losses, and better manage risk portfolios. This leads to more precise underwriting and pricing, ultimately improving profitability and reducing the likelihood of unexpected claims. While traditional models remain relevant, technological advancements are enhancing decision-making and operational efficiency. Question 11. Reinsurance treaties and contracts. Treaty structures and terms. Which of the following is a key feature of a reinsurance treaty agreement? A. The treaty agreement specifies only the premiums the ceding insurer will receive, with no detailed coverage terms. B. The treaty agreement outlines the specific terms and conditions under which reinsurance will be provided, including coverage limits and retention levels. C. The treaty agreement applies only to a single risk and is not applicable for multiple policies. D. The treaty agreement is typically non-negotiable and must be accepted by both parties without modification. Answer B. The treaty agreement outlines the specific terms and conditions under which reinsurance will be provided, including coverage limits and retention levels. Explanation. A reinsurance treaty agreement is a long-term agreement between the ceding insurer and the reinsurer, and it specifies the terms and conditions under which reinsurance coverage is provided. The treaty typically includes important elements such as coverage limits, levels, the portion of risk retained by the ceding insurer, premium rates, and the scope of coverage. Unlike facultative reinsurance, which is specific to individual risks, treaties provide broader, ongoing coverage across multiple policies. Question 12. Financial aspects. Accounting practices in reinsurance. Which of the following best describes the accounting treatment of reinsurance premiums? A. Reinsurance premiums paid by the ceding insurer are recorded as an asset on the reinsurer's balance sheet. B. Reinsurance premiums paid by the ceding insurer are recorded as liability on the ceding insurer's balance sheet and as income for the reinsurer. C. Reinsurance premiums paid by the ceding insurer are recorded as income on the ceding insurer's balance sheet. D. Reinsurance premiums paid by the ceding insurer are recorded as expense for both the ceding insurer and the reinsurer. Answer: B. Reinsurance premiums paid by the ceding insurer are recorded as a liability on the ceding insurer's balance sheet and as income for the reinsurer. Explanation: in reinsurance transactions, the premiums paid by the ceding insurer are recorded as liability on the ceding insurer's balance sheet because they represent the amount that the ceding insurer must pay to the reinsurer in exchange for assuming portion of the risk. On the reinsurance balance sheet, the reinsurance premiums received are recorded as income as they represent the reinsurer's share of the risk and income from the reinsurance agreement. This accounting treatment is based on the principle that the ceding insurer's liability is offset by the reinsurer's income. Question 13. Reinsurance principles. Risk sharing. Which of the following is true regarding the concept of risk sharing in reinsurance? A. Reinsurer's share. A fixed percentage of premiums and losses regardless of the size of individual claims. B. Risk sharing occurs only when large catastrophic claims exceed a predetermined threshold and the reinsurer is responsible for these claims. C. Reinsurers are only involved in risk sharing when the ceding insurer's loss ratio exceeds a certain limit. D. Risk sharing occurs when reinsurers assume the entire risk from the ceding insurer premium. Answer: A. Reinsurers share a fixed percentage of premiums and losses regardless of the size of individual claims. Explanation: risk sharing in reinsurance involves the reinsurer assuming a fixed percentage of both premiums and losses, often as part of a proportional reinsurance agreement. This means that the reinsurer shares in the overall financial risk of the ceding insurer, whether the individual claims are large or small. In non-proportional reinsurance, such as excessive loss reinsurance, involves the reinsurer only assuming responsibility for claims above a certain threshold, which is not an example of shared risk in the same way. Question 14. Claims management. Claim notification and handling procedures. Which of the following is a standard procedure for notifying a reinsurer about a claim under a reinsurance agreement? A. The ceding insurer must notify the reinsurer only if the claim exceeds the retention level. B. The ceding insurer must notify the reinsurer as soon as they become aware of a potential claim, regardless of the retention level. C. The ceding insurer must wait until the claim is paid to notify the reinsurer. D. The ceding insurer is not required to notify the reinsurer unless the reinsurer asks for the information. Answer: B. The ceding insurer must notify the reinsurer as soon as they become aware of a potential claim, regardless of the retention level. Explanation: under standard reinsurance agreements, the ceding insurer has an obligation to notify the reinsurer of any potential claims as soon as they become aware of them, even if the claims have not yet reached the retention level or threshold. This early notification allows the reinsurer to assess liability and engage in any necessary claim handling processes. Prompt notification ensures that the reinsurer can prepare for its financial responsibilities and provides an opportunity to involve the reinsurer in the claims management process. Question 15. Types of reinsurance. Non-proportional reinsurance. Which of the following best describes non-proportional reinsurance? A. The reinsurer assumes a fixed percentage of both premiums and losses. B. The reinsurer assumes responsibility for claims above a specific retention level, but the amount of coverage is capped. C. The reinsurer covers a fixed amount of losses for each policy, regardless of the amount of premium. D. The reinsurer assumes responsibility for all claims regardless of size or frequency. Answer: B. The reinsurer assumes responsibility for claims above a specific retention level, but the amount of coverage is capped. Explanation: non-proportional reinsurance, such as excessive loss reinsurance, involves the reinsurer assuming responsibility only for claims that exceed a certain retention level, a predefined threshold. This means the ceding insurer retains responsibility for claims up to that level, while the reinsurer covers excess. The reinsurer's liability is typically capped at specified amount, providing coverage for large, catastrophic claims without assuming liability for smaller, routine losses. Question 16. Emerging trends and developments. Globalization and its influence on reinsurance markets. Which of the following is a key effect of globalization on the reinsurance market? A. Globalization has decreased the need for reinsurers to consider regional risks and local regulatory requirements. B. Globalization has led to greater competition, making it more difficult for reinsurers to assess risks effectively. C. Globalization has expanded the pool of capital available for reinsurance, allowing for more risk-sharing opportunities. D. Globalization has reduced the frequency of reinsurance contracts written across international boundaries. Answer: C. Globalization has expanded the pool of capital available for reinsurance, allowing for more risk-sharing opportunities. Explanation: Globalization has led to the integration of international reinsurance markets, expanding the pool of capital available for risk-sharing. This enables reinsurers to access capital from a broader range of investors and markets, which increases the availability of reinsurance capacity. Additionally, globalization allows for diversification of risk across multiple geographic regions, which helps to reduce the impact of localized catastrophic events and spreads the financial burden across a larger pool of resources. Question 17. Underwriting and pricing, reinsurance pricing methodologies. Which of the following is the most common method used by reinsurers to price reinsurance contracts? A. Reinsurers typically price contracts based solely on historical loss data without considering future risk exposure. B. Reinsurers rely on the cost of capital to set premium levels, regardless of the underlying risk characteristics. C. Reinsurers price contracts based on the expected risk exposure utilizing actuarial data, historical loss experience, and market conditions. D. Reinsurers price contracts according to highest premium paid in the market to ensure profitability. Answer: C. Reinsurers price contracts based on the expected risk exposure utilizing actuarial data, historical loss experience, and market conditions. Explanation: Reinsurance pricing is typically based on a detailed analysis of expected risk exposure. Reinsurers use actuarial data, historical loss experience, and current market conditions to determine appropriate premiums. The goal is to align the pricing with the underlying, ensuring that the reinsurer can cover potential losses while maintaining profitability. This method considers various factors, including the risk profile of the ceding insurer and external market conditions. Question 18. Reinsurance principles, reinsurance capacity, and underwriting considerations. Which of the following is an important consideration when determining reinsurance capacity? A. The financial strength of the ceding insurer is the only consideration when determining reinsurance capacity. B. Reinsurers assess their available capital and risk tolerance, considering the size and nature of the risks they are willing to assume. C. Reinsurers do not consider underwriting criteria as they rely solely on the premium paid by the ceding insurer. D. Reinsurers determine capacity based only on the number of claims handled, ceding insurer in the past year. Answer: B. Reinsurers assess their available capital and risk tolerance, considering the size and nature of the risks they are willing to assume. Explanation: When determining reinsurance capacity, reinsurers evaluate their available capital and risk tolerance to ensure they can effectively handle the potential risks assumed under a reinsurance contract. This assessment involves considering the size and nature of the risks, including the types of coverage required, the historical loss experience. It helps reinsurers establish appropriate limits and pricing, ensuring they are not overexposed to risk. Question 19. Types of reinsurance. Catastrophe reinsurance. What is a key feature of catastrophe reinsurance? A. Catastrophe reinsurance provides coverage for small, frequent losses that the ceding insurer cannot handle. B. Catastrophe reinsurance is specifically designed to cover large, infrequent losses resulting from natural disasters or other catastrophic events. C. Catastrophe reinsurance is applied only to the most profitable policies, excluding any high-risk exposures. D. Catastrophe reinsurance provides coverage for claims that are less than a specific threshold, typically related to everyday claims. Answer: B. Catastrophe reinsurance is specifically designed to cover large, infrequent losses resulting from natural disasters or other catastrophic events. Explanation: Catastrophe reinsurance is a form of non-proportional reinsurance that provides coverage for large, infrequent losses typically resulting from natural disasters such as earthquakes, floods, or hurricanes. It is designed to protect the ceding insurer from the financial impact. Catastrophic events that could exceed their ability to handle the losses. The coverage is triggered when losses exceed a predetermined threshold, providing a safety net for extreme situations. Question 20. Claims management. Dispute resolution in reinsurance claims. Which of the following is commonly used to resolve disputes in reinsurance claims? A. Mediation, where an independent third party helps both parties come to an agreement. B. Arbitration, where a neutral third party makes a binding decision based on the merits of the case. C. Litigation, where claims are resolved through a formal court process. D. Direct negotiation between the ceding insurer and the reinsurer without third party involvement. Answer: B. Arbitration, where a neutral third party makes a binding decision based on the merits of the case. Explanation: arbitration is a commonly used method for resolving disputes in reinsurance claims. In arbitration, a neutral third-party arbitrator evaluates the merits of the case and makes a binding decision. This process is often chosen for its ability to provide a quicker, more efficient resolution compared to litigation. Mediation, option A, is another alternative, but it typically results in a non-binding agreement, whereas arbitration results in a final enforceable decision. Direct negotiation without third-party involvement is common but may not always resolve disputes effectively, especially when there are significant differences in interpretation or expectations between the parties. Question 21. Which of the following is a characteristic of a treaty reinsurance agreement? A. It is negotiated for each individual policy and only covers specific risks. B. It applies to a specified class or type of business for an agreed period, with the ceding insurer automatically ceding risks within that class. C. It is a short-term arrangement covering only catastrophic events. D. It requires separate agreements for each individual risk transferred to the reinsurer. Answer: B. It applies to a specified class or type of business for an agreed period, with the ceding insurer automatically ceding risks within that class. Explanation: treaty reinsurance agreements are automatic arrangements between the ceding company and the reinsurer that apply to a specified class or type of business. The ceding company automatically cedes all risks within the defined class or type of business to the reinsurer for the duration of the period. This differs from facultative reinsurance, option A, where risks are individually negotiated. Option C refers to excessive loss reinsurance, and option D describes facultative reinsurance agreements. Question 22. In reinsurance, the term capacity most closely refers to A. the maximum amount of insurance the ceding insurer is allowed to write under state regulations. B. the amount of risk the reinsurer is willing to assume within a given time period. C. the ability of the ceding insurer to transfer risks to another insurer. D. the process of adjusting the premiums paid by the ceding company to the reinsurer. Answer: B. the amount of risk the reinsurer is willing to assume within a given time period. Explanation: capacity in reinsurance refers to the amount of risk that the reinsurer is willing and able to assume in a given period. Reinsurers often have a limited capacity based on their financial strength and risk appetite. Option A refers to the regulatory limits on the ceding insurer, while option C involves the ceding insurer's ability to transfer risks. Option D is related to pricing and premiums, but not directly to the concept of capacity. Question 23. What is the key benefit of using proportional reinsurance arrangements for the ceding company? A. It limits the reinsurer's responsibility for losses above certain threshold. B. It allows the ceding company to spread its risk across multiple reinsurers. C. It provides the ceding company with predictable level of risk sharing. D. It enables the ceding company to avoid paying any claims to policyholders. Answer: C. It provides the ceding company with a predictable level of risk sharing. Explanation: proportional reinsurance arrangements such as quota share provide a predictable and consistent level of risk sharing between the ceding company and the reinsurer. The ceding company and the reinsurer share the premiums and losses in an agreed percentage, making it easier to forecast both the risk and the financial impact. Option A refers to non-proportional reinsurance, while option B refers to the use of multiple reinsurers, not a direct benefit of proportional reinsurance. Option D is incorrect, as the ceding company still pays claims to policyholders but transfers a portion of its risk. Question 24. Mr. Thompson is an insurance company underwriter who is evaluating the reinsurance needs for his company. The company has recently experienced a significant number of large claims, leading to concerns over the financial impact of future events. Which type of reinsurance would Mr. Thompson likely consider to protect against these large, infrequent claims? A. Quota share reinsurance. B. Excessive loss reinsurance. C. Surplus reinsurance. D. Facultative reinsurance. Answer: B. Excessive loss reinsurance. Explanation: excessive loss reinsurance is designed to protect the ceding insurer against large and frequent claims by covering losses above a specific threshold. This type of reinsurance is ideal for dealing with catastrophic events or unexpected large claims, as it provides a safety net for claims that exceed a predetermined amount. Offshore as a quota share and option C, surplus reinsurance, are types of proportional reinsurance which distribute risk proportionally, but they do not specifically address large, rare losses. Facultative reinsurance, option D, is typically used for individual, high-risk policies rather than for general protection against large claims. Question 25. Which of the following is a primary objective of reinsurance? A. To increase the underwriting risk for the ceding insurer. B. To enable the ceding insurer to reduce its exposure to large or catastrophic losses. C. To limit the ceding insurer's ability to grow its portfolio of business. D. To eliminate the need for the ceding insurer to maintain financial reserve for claims. Answer: B. To enable the ceding insurer to reduce its exposure to large or catastrophic losses. Explanation: the primary objective of reinsurance is to reduce the ceding insurer's exposure to large or catastrophic losses by transferring some of the risk to the reinsurer. This allows the ceding insurer to maintain a more stable financial position even in the face of large claims. Option is incorrect because reinsurance aims to reduce underwriting risk, not increase it. Option C is incorrect because reinsurance often enables insurers to grow their portfolios by providing additional capacity. Option D is incorrect because reinsurance does not eliminate the need for reserves. It may reduce the size of the reserves needed. Question 26. Which financial metric is most important for reinsurers when evaluating the solvency of a ceding company? A. Loss ratio. B. Solvency ratio. C. Combined ratio. D. Underwriting expense ratio. Answer: B. Solvency ratio. Explanation: the solvency ratio is crucial for reinsurers when evaluating the financial health of a ceding company. This ratio compares the ceding company's capital to its liabilities, indicating its ability to meet long-term obligations and absorb losses. The loss ratio, option A, measures claims paid relative to premiums earned, while the combined ratio, option C, evaluates overall profitability, including both claims and expenses. The underwriting expense ratio, option D, measures the proportion of premiums used for operating expenses but is less important for assessing solvency. Question 27. In reinsurance, which of the following best describes retrocession? A. The process of a reinsurer transferring part of its assumed risk to another reinsurer. B. The transfer of risk from the ceding insurer to the primary insurer. C. The act of a ceding insurer retaining more risk than it cedes to the reinsurer. D. A form of facultative reinsurance for catastrophic events. Answer A. The process of a reinsurer transferring part of its assumed risk to another reinsurer. Explanation: retrocession is the process by which a reinsurer transfers a portion of the risk it has assumed to another reinsurer. This allows the primary reinsurer to manage its risk exposure and capacity. Option B is incorrect as it describes a transfer from the ceding insurer to the primary insurer. Option C refers to retention, not retrocession. Option D describes catastrophe reinsurance, not retrocession. Question 28. Which of the following is most likely to occur in a scenario involving facultative reinsurance? A. The ceding insurer automatically transfers risks under the terms of an existing treaty. B. The reinsurer assumes the entire risk for a specific policy after reviewing the individual risk. C. The ceding insurer accepts all terms and conditions proposed by the reinsurer. D. The ceding insurer and reinsurer agree on a fixed percentage of all premiums for all policies. Answer: B. The reinsurer assumes the entire risk for a specific policy after reviewing the individual risk. Explanation: facultative reinsurance involves the ceding insurer offering a specific policy to the reinsurer for individual evaluation. The reinsurer has the option to accept or decline the risk based on the characteristics of the policy. Option: it describes treaty reinsurance where risks are automatically covered. Option C is incorrect, as facultative reinsurance involves negotiation and evaluation of individual risks. Option D describes proportional reinsurance agreements but does not apply to facultative arrangements. Question 29. What is the role of A reinsurance broker in the reinsurance process. A. To underwrite risks and set the terms of the reinsurance agreements. B. To evaluate and accept risks transferred by the ceding insurer. C. To act as an intermediary between the ceding insurer and reinsurers, facilitating negotiations and placements. D. To determine the appropriate reserves needed by the ceding insurer. Answer: C. To act as an intermediary between the ceding insurer and reinsurers, facilitating negotiations and placements. Explanation: Reinsurance brokers act as intermediaries who facilitate negotiations between ceding insurers and reinsurers. They help the ceding insurer find the appropriate reinsurer for its risks, negotiate terms, and place reinsurance coverage. Brokers do not underwrite risks. Option A. Evaluate risk. Option B. Or determine reserves. Option D. Their primary role is to connect insurers and reinsurers and assist in structuring the reinsurance arrangements. Question 30. Which of the following is a primary challenge faced by reinsurers when pricing reinsurance contracts? A. The availability of investment opportunities to generate returns. B. Accurate forecasting of catastrophic events and large claims. C. Compliance with state regulations regarding capital reserves. D. The ability to predict the ceding insurer's long-term solvency. Answer: B. Accurate forecasting of catastrophic events and large claims. Explanation: Accurately forecasting catastrophic events and large claims is a primary challenge for reinsurers when pricing reinsurance contracts. Reinsurers must estimate the likelihood and potential severity of such events to determine appropriate pricing. While options A, C, and D are relevant to reinsurers' operations, they are secondary to the core challenge. Pricing based on risk exposure, which is often dominated by catastrophic events.